FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video. And in this video guys, we're going to take a look at a question that I get asked on a lot. And the question is pretty simple. What is the difference between a market maker cycle that has 3 levels versus one that has 4 levels? What's the difference? Why is one has 4 versus 3? So that's what we're going to talk about in this video today. We actually covered this exact subject a couple of weeks ago on our mentoring group that we do every week with our students. So I figured I'd share that part of the video with you that kind of explains essentially why one's 3, one's 4. So hopefully you get some value out of this, guys. And without further ado, let's get this video started.
So typically you would have this pattern here, right? Right. And so that would be your peak, your 1, your 2, and your 3. But why do some have 4 and not just 3? So why do some look like this, where it has 3 down and an extra 4? You know what I mean? The only reason that this one has extra 1 down is because by the time they got to this third one, instead of coming back up again, they didn't have enough people selling to do so. So they needed to go down one more level to get more people to sell. You have to think about the psychology of how this works with retail traders. The majority of retail traders, right, they're not going to get into the trend here. Some will get here, most will get here. So the mindset is like, you're thinking this is when this happens here and they're right here. Whenever you have a peak and you have level 1 here and it drops, this gets people's attention. This gets the retail traders' attention, right? When it gets to level 2 and they're doing this and they do this, I would say if you have 100 traders, retail traders, right, that are watching this, I would say good maybe 30% to 40% of them are going to get in here on a trend, right? And then you get this right here. This gets the rest. This gets the bulk of the traders going into the trade because they've seen it twice already. Okay, this is a good. They start putting in their trend lines, right? They're like, this is a good trend. So I'm going to get in here. And this is the worst possible place to get in at. The problem is that what happens is when you make a move or when they make a move, they expect to get a certain number of contracts each time they retrace. When they don't get that number of contracts, they have to go one more down because they have to convince more people to sell. The biggest disadvantage that we're all going to have, no matter what strategy you trade, is the fact that you don't know the numbers that they need.
Right.
That's the problem.
So, Mark, along with that, then is fundamentally the reason for a reset that people are starting to, in this case, go bearish, and so they're gonna like knock all of their stop losses out before going bearish again, or
Yeah, so think of it like this. So if you're talking about, this is just to say this is like 3 levels and then a peak formation, right? So if you're talking about a reset, then we're not talking about they need more traders to go down one more level. Now we're talking about they need to get to a certain number,
right? So we're not talking about levels anymore. We're talking literally about numbers. So if this started at like 140, 143, let's say, right? But their overall number that they're trying to get to before they make a huge reversal is like, let's say 133. Well, you can't get from 143 to 133 just by dropping, 3 levels, because the gap is going to be way too big. It's way too big of a move pip wise, you know? So you could do 3 levels down, let's say, to get to maybe, 138, 139, go up 1 level, and then reset it so you can keep going to 133.
Got it.
Do you get what I'm saying?
Yeah.
So the resets are already pre-planned to begin with. So there's two different reasons why they would reset versus why they would just go 1 level more down. And so you can take it to a macro level or a micro level on a intraday chart of a 15-minute chart of, like, having the Asian session, right? And then them going up for like a type 1. Well, why would they go up higher and then come down again? Why not stop here? What's the reason that they need to do this?
They want to convince everybody to go
Right.
bullish, so they're trapping them.
They need more people, right? Exactly. They need more people, right? So what's the difference between them doing that versus doing this on a type 1? Is because they already have the people. Or them doing this on a type 1 because they already have enough people trapped, so they don't need to go back all the way back up. They go all the way back up, they let people out with a break even trade. The only thing that we have that we can use to try to identify this is literally the behavior of the candlesticks that they present. This is why we talk about railroad tracks on the second leg, or star patterns on the second leg, or a pattern where you have 2 dojis and then, a solid, 2 solid bars next to each other after that. These are all patterns. That's all that is. These are all behavioral patterns. All right, guys, welcome back. I hope that the video essentially brought value to you, in the sense of showing you the difference essentially between the Y3 versus 4. Okay, so if you like videos like this, you like content like this, give us a thumbs up, give us a like, subscribe to the channel, share the content. If you need any help, guys, we have a next mentoring class that starts in 14 days. The links are in the description. Thank you so much and have a great rest of your day.